Hello, everyone. We are going to go ahead and get started. Welcome to today's webinar, ASC-842 Rule Impacting Financial Decision Making, sponsored by GBQ Partners, LLC. Today's presenters are GBQ's Assurance and Business Advisory Services Senior Manager, Tobin Perrell, and Assurance and Business Advisory Services Manager, Kristen Romaker. Now I'll turn the call over to Tobin to start today's webinar.
Thanks, Kyrie. Appreciate everybody for coming out today and joining us for this hour webinar. I think there's going to be a lot of great content and information for you all. Some of it maybe review, but the lease standard is upcoming fast and furious. So you've probably heard us say it 100 times already, and we'll hear it said 100 times more. But appreciate you coming out, and I think there'll be some good content here. As Kyrie mentioned, my name is Tobin Perrell. I'm a senior manager in our audit practice here at GBQ, and privileged to have Kristen Romaker join me as a co-host today. She is the fresh face of the senior manager group here at GBQ after a recent promotion last month. So kudos to her, well deserved. And also, she'll probably kill me for saying this, but the in-house subject matter expert on leases, all things leases here at GBQ. So Kyrie, next slide. The agenda for today, few things here we're going to talk about. An ASC-840 versus 842 overview. It's going to kind of show high level what the impacts are going to be with this new lease accounting standard that's upcoming, how that'll impact financial statement numbers, as well as disclosures in your financial statements. And as you'll see, some of you may have sat through similar webinars in the past, and this may be a little bit more of just a refresher versus something you're seeing for the first time. But as everybody will see, there's going to be some significant impact associated with this across the board. Some industries more than others, but almost all companies and organizations will be affected by this. And then lastly, we'll do a bank compliance case study. What we're going to show here is more so how this may impact your compliance with your lenders, financial covenants, and those calculations. We've been saying that for a while. It's going to be a big part of this, and you should be having conversations with your lenders sooner rather than later. And so we'll show a case study over this as well and some of those impacts. Next slide. And then the objectives kind of just mirror what that agenda was previously. So Kyrie, we can move to the next slide again. And our first CP activity, the code word there is rule. There should be a poll pop up. First word again is rule. All right, wonderful. So now, without further ado, I'm going to turn it over to Kristen, and she'll go through this lease portion here for the next 20-25 minutes, and then I'll come out of the bullpen and bring us home from there. So, Kristen, take it away.
Thanks, Tobin. Okay, so as Tobin said, I should be a familiar face if you've attended our webinars before. I'm kind of helping Mary Stuckey, partner at GBQ, with rolling out this lease initiative. And so we're super excited for you to join us again today. Kyrie, you can, oh, you're on the right side. Okay. So again, these are, the first couple slides are, some repeats that you guys have seen before, but we wanted to just spend a few minutes going over the standard itself. It's good to have a refresher, obviously, because many of you if all of you on the call haven't implemented yet. So if you're like me, this standard has been coming for as long as I can remember. It's definitely been more than a decade. So the current lease standard has been the same for over 30 years. And finally, in 2016, FASB issued new guidance for leases that will have significant impact on the lease accounting model and will affect every company that has leases more than 12 months. So The guidance was originally set to be effective for private companies for years beginning after December 15, 2019. However, this has been deferred on 2 separate occasions for an additional year in each instance. So if you go to the next slide. Just a quick graphic to show the dates a little easier. So public entities were implemented in years beginning after 12/31/18. So those have been great examples for private companies. So as a result, the leases is now required to be implemented by private companies for fiscal years beginning after December 15th, 2021. Which will be calendar year 2022 for most entities and most of you on this call. The new lease standard is effective on 1/1/2022. However, it's important to know your reporting requirements. For instance, if you only have an annual reporting requirement, you could wait closer to the end of 2022 or do it in the first quarter of 2023 in order to be in compliance with GAAP. So really it's just knowing when you need to have your GAAP, first set of GAAP statements in 2022 if your fiscal year is ending after 15. So just a quick crash course. So the end game is to get all leases with service lengths greater than 12 months onto the balance sheet. Leases 12 months or less in length are excluded from the standard, and those will be expensed on a pro rata basis over the balance or over the lease term with no impact to the balance sheet. So that's what's happening now. The current operating and capital terminology is replaced with operating and finance leases. Finance lease requirements remained relatively unchanged outside of some wording changes to the bargain purchase option. And there is a new 5th category for specialized nature assets that only the lessee can use. So that just means that there's no alternative use for the lessor without a significant modification to the leased item. But we have found that if you're triggering the 5th category, you're most likely have triggered one of the other 4th criterion. So it hasn't had much impact. And next slide, please. And next slide. So this is just a quick comparison between 842 and 840. I'm just going to call out a few of the big differences. So the fixed payments will likely be included in base rent as these payments are known and fixed throughout the life of the lease. In substance fixed payments are payments that may appear to be variable but could in effect be unavoidable that might need to be considered. The lease classification is determined at lease commencement versus execution, so that is one big difference. Also, there is some consideration of insurance, taxes, maintenance, where those weren't included under 840. We already discussed the 5th criterion, so that doesn't need to be discussed again. And we're also, the asset will be recorded under 842 using a discount rate. And the only expected amounts owed at the end of the lease term should be included in the lease payments under 842. So that's just a quick overview just to highlight some key terms that we'll discuss in the presentation. So you can go to the next slide. This is just a quick slide for some considerations of things to think about while we're going through this plan. So the fixed rent, you might want to consider doing a fixed rent account. We could also consider a short-term rent account and a variable rent account. So this is just on the expense side as we're going through this. The example that we're giving is very basic in nature, so you'll see that. If you go to the next slide. So we're going to walk through what an operating and finance lease example would look like. I'm just going to go over the fact pattern briefly. So the lease that we're going to talk about is a 3-year lease that's effective on 1/1/2022 through 12/31/2024. It had a $300,000 present value of future lease payments. The payment stream, so the cash outlay in year 1 is $100,000, year 2 is $110,000, and year 3 is $125,000. We're using a 5.51% rate for the implied interest. There's no renewal periods being considered and no initial direct costs. So this is a very straightforward example, and we've elected some of the practical expedients that we'll discuss a little bit later. But as you see, we do have escalating rent payments, and it does have a shorter lease period. So next slide, please. So the first example, the fact pattern, as you can see, is on the left that we just reviewed. This is for a finance lease. It was determined to be a finance lease. And then for simplicity's sake, we're also looking at this on an annual basis. Your entries would look similar, but obviously much smaller on a monthly basis. But if you added up all your monthly entries, this is what your annual entry would look like. So you can see on the first line item, we are doing the right of use asset and the lease liability at $300,000. So that's the present value of the future payments at 1/1/2022. And then we will, in the second part of the first year entry, would be to have, under a finance lease, you have interest expense. So the interest expense is listed. Amortization expense is basically just your rent expense, and the lease liability are all being debited, and then your ROU is being amortized by that $100,000, which is just the straight line of your amortization expense. And you can see your cash outlay is $100,000 in year 1, which is your lease liability plus your interest expense. In year 2, you can notice that the amortization, the rent expense continues to straight line, and the lease liability and the interest are still equal to the ratable straight line decrease. However, you will notice that the cash did change to reflect the uptick in the rent escalation. And then year 3 is just, finishing out the lease. So your interest expense is going to decrease as your lease liability increases slightly in the amount, and then we're still doing our straight line amortization expense or rent expense, and our cash is at the $125,000, which was the cash paid during the year. If you go to the next slide, we are reviewing the operating. So, we went through our four criterion and we determined that this is an operating lease. So you will notice that we still have the same ROU asset and liability as the finance example we just showed at the $300,000. And the large difference in the entries is that we will not split out interest expense, as there is no financing type component. So your lease expense in the operating example, it is primarily what the interest and the lease liability was. And then we'll still be reducing that lease liability. The ROU asset will be then reduced incrementally over the straight line period. And then you can see the cash outlays are the same. If you go to the next slide, here is a comparison between the examples we just reviewed right next to each other, where you have the effect on, you can see the effect on the cash flow presentation between finance and operating leases is what the bigger impact is here. So an operating lease obviously has a larger impact on in the operating section of the cash flow than the finance lease, which is mostly being shown through the finance section. Next slide, please. Okay, so just some takeaways that I briefly discussed, but just a review of those entries. So the recognition patterns for capital and finance leases are relatively unchanged under ASC-840 versus the 842. The biggest changes are the enhanced disclosures, which we'll talk about here in a moment. The primary difference in the recognition pattern between operating and finance leases is how the ROU asset is being amortized. So the ROU asset for financing lease is amortized over the shorter of the estimated useful life of the term of the respective leases. So basically in the example we just did, it was over 3 years, where an ROU asset for the operating lease is amortized based on the total rent expense compared to the amount representing interest. So that's why you notice in those examples that there was a slight difference between what was hitting the P&L in those cases. So additionally, and I briefly discussed this, that the operating lease will result in a greater impact to the operating cash outflows when compared to a finance lease, because it's more in comparison to a debt. In the next slides, we are going to walk through some examples from the Wendy's 10K. So as you can see below is what we currently, as private companies, have for presentation. Obviously, Wendy's has a lot of leases compared to some of private companies, but this is what you're more familiar with seeing for a rental expense, and then breakout of the rental payments between capital leases and operating. And the private or the public companies have been able to give different examples, which I think is super helpful. Also, if you remember your own financial statements, you maybe have 1 or 2 paragraphs. If you go to the next slide, you will see that there is the operating lease asset is highlighted, which is new. The finance lease asset right above it would be the old operating, but it is being broken out from the fixed assets. And then you will see there is a current portion of operating lease liabilities and a current portion of finance lease liabilities. And then there is the long-term portion. You will also notice that there is no comparative. So Wendy's, which we'll see later in their narrative disclosure, elected the practical expedient to not show comparative, which makes the implementation much easier, that this is modified retrospective. If you go to the next slide, here is just a snip of their retained earnings and of their cash flow. So when Wendy's did implement, they impaired some leases. So that's why they had a change in retained earnings. That's not as common unless you make some change to what you've already decided in previous years. And then you will see through not doing the comparison that there is the change in the cash flow, the highlight there, that the change in the operating lease liability is flowing through that operating section. Then next slide, please. So here is where they start the actual disclosures in the footnotes. So you will see that there is a distinguish between the finance and operating leases. They also have some variable lease costs and short-term lease costs in there to get to their total lease cost for the year. And then the table below is for the supplemental cash flow to provide more information between operating and finance leases, as well as the right of use assets between finance and operating leases. Next slide, please. So you can see here that this, again, is just some supplemental information for the reader between finance and operating leases. And then the following table, it was just be your future minimum rent payments. As you can see, this is much more robust between finance and operating leases, and then also has the interest line item to get to the present value to match the financial statements. Next slide. So here is a narrative, again, this, pulling from Wendy's 10K. As you can see that this disclosure went from a paragraph or two to 4 paragraphs. So the first paragraph is just, opening about the implementation. So this will eventually go away. It will reduce the disclosure a little bit, but the second paragraph is discussing the practical expedients that were elected. And then the third paragraph is them discussing the quantitative changes that they elected and how it affected the financial statements. And then the fourth is just going through the, what was reclassed from ROU assets from finance and the current portions that they've added. If you go to the next slide, I think we are on to our second CPE word, which is decision. So that poll should come up. Great. So I wanted to quickly, before we get into the banking compliance case study, just talk through the practical expedients. So, what is a practical expedient? Really, this is just a relief effort by the FASB to assist preparers to more easily apply the guidance. So there are bulleted here a few. So there are 3. There's a practical expedient package. They must all be adopted on an all or nothing approach. So, there's no reassessment of lease classification, and no reevaluation of existing or expired contracts for embedded leases, and no reassessment of previously recorded initial direct costs. So this is the most common election as it reduces the most time when evaluating your leases. It is important to note, though, that if because it is all or nothing, there may be something to change in there if you decided to reevaluate, that a finance lease can affect the EBITDA. And as a result, you could yield a more preferred outcome depending on what if your leases changed from finance to operating. So that is a consideration. Another practical expedient is a hindsight, which would be like lease terms or options. So electing this practical expedient allows the lessees to make assumptions regarding the lease term by what's currently happening in the information. So this is most common in renewal options. So if you know that you have a renewal option you're going to do because you're at the end of your initial lease term and the renewal option starts next month, you're most likely going to elect to have that renewal option. Pros and cons is that you can be more precise at implementation, but this could take more time to implement. The next one is the combination of lease versus non-lease components. So this would require the present value of fixed consideration to be calculated. So the fixed lease payments would exclude the additional costs such as CAM or insurance, but this could be elected based on asset class. There is the private company election for discount rates where you can just use a risk-free rate and that you don't have to look at your incremental borrowing cost. Using the risk-free rate, though, will result in a larger lease liability on the balance sheet, but it's also going to result in a larger right of use asset as well. So there's some pros and cons there just to think about. And then also there is the land easement expedient, which this is just historical treatment applies there where land leases aren't considered. So that wraps up my side of the presentation, and I'm going to turn it back over to Tobin.
Wonderful. Thank you, Kristen. Very insightful and good information. And as everyone could probably see, I mean, this is going to be a significant thing. It's, you don't want to sell it short, or also don't want to scare people or anything, but depending on your lease portfolio, this is going to be a very significant undertaking, both from an internal time and effort spent as far as getting everything in order to adopt the standard and the impacts to your financials. But then, I mean, as you can see, there's going to be significant impacts to the financials as well. So, I mean, as far as banking compliance and everything's concerned, Kyria, actually, could you fast forward to the next slide, maybe a couple slides ahead? Yeah, let's see. Okay, well, I can talk about this too first. Sorry, before we talk about banking compliance, we can talk about a kind of lease tracking and what that might look like. As Kristen alluded to, there's going to be a lot of ins and outs with this. And for companies that only have a couple leases, and it's fairly simplistic, maybe you can get away with an Excel spreadsheet. As far as that's concerned. But for your larger organizations, especially restaurant, retail, organizations that have a large portfolio of leases, some manufacturers and distributors, what we've been seeing is the usage of third-party software solutions. Some considerations as far as that goes. I mean, the number of leases that are going to need to be tracked, complexity of terms, and on down the line. GBQ has partnered with LeaseCrunch as far as a lease tracking solution is concerned. Lease Query is another one you'll hear and see about out in the marketplace. Some organizations have opted to utilize some of those softwares internally, and others have opted to utilize the LeaseCrunch partnership that we have. Where what that's going to look like is more of a portal where lease activity, lease parameters, numbers, maturity dates, renewal terms, everything are entered into. And then what these softwares will actually do is provide journal entries and everything to record to accurately track the lease portfolio. Next slide, Kyria. And then this, as I was mentioning, is the LeaseCrunch partnership that we have. It's going to just simplify some of the complexities associated with the lease standard. We have entered into engagements where our clients and other folks have done all the data entry and everything else. We just have access to the numbers and to pull the data and verify some of it. And that's a very cost-effective approach. Some organizations we work with as well have preferred the option where GBQ does some of that data entry and other inputs, and that's a perfectly fine approach as well. But we found that LeaseCrunch is a very easy tool to work with, very easy to implement, and very cost effective. So for anyone wanting more information about that, feel free to reach out to Kristen or myself. I'd be more than happy to talk about it. Next slide. Okay, so now we'll get to the lender compliance section of this webinar. And just as a high level overview, I mean, for companies and organizations out there, I know we have a few bankers and lenders that have joined us today as well. For anyone out there, I mean, within your credit agreements, whether it's just a line of credit, whether you have a line of credit mixed with some term loans, equipment financing, other financing, more times than not, there's some sort of financial covenants associated with that. It obviously depends on the risk portfolio, company financials, and the leverage there as far as total debt's concerned. But more often than not, there's going to be financial covenants associated. If failed, there's usually acceleration clauses and other items present in the lease. These covenants are more so a safeguard for the lenders to determine, hey, if there's deteriorating cash flow, companies become over leveraged, gives them a safeguard as far as their funds are concerned that they've lent. Considerations, though, will have to be made if any of these financial statement covenants are failed, which, depending on the reason, a lot of times you as the company organization, you can get a covenant waiver. We will require it as far as an audit's concerned or a review of the financials. What those waivers essentially say is that the lender acknowledges the covenant failure, but then also is not going to accelerate or call any of that debt within the next 12 months. And that's factored in as far as going concern considerations that we make or you're making as part of management analysis, and also debt classification, because if a covenant's failed and the bank's going to accelerate that debt, then that would be required to be marked as current in your balance sheet versus long-term. And then shuffling things around can obviously affect ratios and other going concern considerations there. So given the significance of some of the financial statement presentation changes that Kristen discussed in pretty good detail previously, you saw not only disclosures, but also significant impact to the balance sheet. And due to the significance of this, compliance ratios, as currently written, have the potential to significantly change. And some high level, is not high level, there's a list of 4 ratios here, covenants that we're going to go through in a little bit further detail. I'll show you a case study and an exercise kind of before and after 842 implementation, so you can see the impact of that. This is not an all-inclusive list. I mean, I've seen dozens of different covenants within lending arrangements. Most of the time, what I end up seeing is some sort of a coverage ratio, whether it be fixed charge, debt service, which we'll go through here, and then also some sort of leverage ratio, whether it's a funded debt to EBITDA metric or something along those lines. But there's usually a combination. So I wanted to give a good overview of these, but no, this isn't all inclusive. So for specific scenarios, feel free to reach out with questions or concerns you have as well on that, and how it might impact it. So Kyrie, next slide. So as far as communication goes with your lenders, we recommend that communications being had sooner rather than later. I know it might be hard with implementation not coming for at least another 5 months, assuming you do it early in 21 and figure out the impact there, or it could be a little bit over a year away. So it may be hard to know the full scope of what that's going to look like until you go through the exercise, but at least communication should be had with your lender based on your current lease portfolio, how you think these covenants maybe would change, and some of these ratios might change, just to get ahead of it. What we're expecting will happen. There may be gap exceptions that'll be included, such as covenants the way they're currently written, are in compliance with gap, and maybe there's some changes there to be gap with except for ASC-842 and keep it under legacy language, or there may be adjustments to thresholds, or there may be some lease activity included within these calculations. And I've got a few examples later to show as far as a lease leverage ratio and how maybe the impact will be a little bit less significant there. Some of our friends in the restaurant, retail, other industries with a heavy lease portfolio, those are already typically included in their covenant calculations, and I'll show you an example of what that looks like. And that's kind of what the bottom bullet here in the slide is referring to, how businesses in certain industries, they already have the rental expense and components added into their calculation, and the changes might not be as significant in those instances. So next slide, Kyrie. So what I'm going to try to do here is a before and after, and not to throw too many jokes in there. When I hear before and after, I kind of always just think of Wheel of Fortune. So I'm not going to be Pat Sajak up here, but if he's out there watching somewhere, a foot-long sublease would maybe be a good before and after puzzle to utilize down the road, but just a little humor for what we're going through today. I'm going to illustrate before and after what that'll look like versus ASC-842, the current guidance for private companies, and 840 and then 842, which will be the current guidance moving forward. So next slide, Kyrie. So here's some summary financial data I put together. And this is, I didn't pull this from any company in particular, I just tried to give some summarized data to show high level what this might look like. If it was in an accounting textbook, I'm sure it would be ABC company or XYZ company. That tends to be the only thing. And I'm sure they manufacture widgets. But anyhow, here's some summarized financial data. Show the balance sheet changes there. As you can see in the left column, that's ASC-840 legacy guidance. The right column is ASC-842. The big change really here, and again, this is a simplistic high-level overview, but the big change is going to be that right-of-use asset and the lease liabilities being added, which grossed up the balance sheet by $2 million. The right-of-use asset's all going to be long-term, presented similarly to what your property and equipment would be. But then the lease liability on the liability side will be broken into current versus long-term portions there. So as you can see, again, this is a simplistic approach, assuming a 100% operating lease portfolio, no impairment or other equity charges at the implementation date. So no changes in equity. The only change there is in the balance sheet. And then some of the supplemental information below, no changes to net income, interest, income taxes, EBITDA makeup, or rent expense as far as this implementation. Next slide, Kyrie. So the first two ratios we'll go about here pretty quickly since they're pretty simplistic. It's just looking at the current ratio and also the debt to net worth ratio. Current ratio is just going to be your current assets over current liabilities. And since all the right-of-use assets were marked to long-term, but the current portion of those lease liabilities are marked to current, your current ratio is going to drop upon implementation of the standard. And in this example, assume that there is a required covenant of a 1.3 current ratio. The addition of a couple $100,000 of current liabilities there would actually trigger the failure of this covenant as it's currently written. And then the debt to net worth ratio below is going to be your total debt divided by your total equity, essentially, your total net worth. You can see there's no change to net worth as we previously discussed, but depending on how the covenants are written, there would potentially be a $2 million increase in that debt number. And that's another thing I think we'll see pretty commonly as far as the way these lending arrangements are written. For instances where the way they're written, lease liabilities would kind of be included in that debt number. They may or may not be excluded depending on how they're written. But just something that you should be having conversations with your lender, just so there's no confusion upon adoption if you have to add a couple $1 million of liabilities or more. And you can see that affect your ratios and making sure you're in line in those conversations before adoption. Next slide, Kyrie. So the next ratio we'll talk about here is the funded debt to EBITDA. And EBITDA is just your earnings before interest, taxes, depreciation, and amortization, a very commonly used metric to evaluate that free cash flow there. EBITDA is not going to change pre and post 842 in this scenario. There are scenarios where it would change, as Kristen was mentioning with finance versus operating leases, but in this scenario, simplistic scenario, there's no changes there. But if that funded debt number, if your lease liabilities are included there, it's going to increase that funded debt number, which in turn is going to make you appear more leveraged on that front, with the ratio increasing to 5 from 3.75. And if the required ratio there was a 4.0, you would go from a pass to a fail again, as far as that covenant's concerned. And it's just, This is why we're recommending these conversations. I think the conversations will go smoothly and go well. Lenders understand this is upcoming. Businesses may not know the extent of the impact, but know there's going to be some impact. But pre and post ASC-842, this doesn't mean your business is fundamentally changed, and the lenders will understand that, and it's just a good conversation point, even for businesses that add a significant amount of leases to their balance sheet. I was just doing a few quick searches on the SEC Edgar portal before this presentation, and for some of your restaurants and retailers, got some numbers here. Wendy's, when they adopted, their balance sheet grossed up by about 20%. Now, again, they're heavily franchised, so not as many leases as, say, a Chipotle, which is company-owned locations. Chipotle's balance sheet actually increased by about 50%, or the leases may have actually increased about 100%, but leases made up 50% of their balance sheet after implementation. And in a similar manner, Bath and Body Works and Big Lots are about 30 to 40%. So could significantly change the funded debt makeup and the numbers on your balance sheet. So it just makes sense to have those conversations. Next slide, Kyrie. As I was mentioning previously, for those that already have lease activity factored into their covenants, these are going to be entities that are with larger lease portfolios, primarily restaurants, retailers, maybe some manufacturers and distributors, depending on multi-locations and things of that nature. Lease activity may already be included in these calculations. Typically what I've seen is like a total funded debt number to your EBITDAR, which EBITDAR is just EBITDA plus rent expense. And then in instances such as this, a rent expense times a multiple is going to be added to the funded debt to come up to this ratio. Rent expense times about 6 to 8 seems to be a pretty common multiple that I see. And in this scenario, as you can see, since EBITDAR doesn't change and the total funded debt number wouldn't change, the actual covenant ratio would change in this instance. So we'll see if this is a more commonality moving forward, but just wanted to showcase this for those that may already have this included, lease leverage provisions included in their covenant calculations. Next slide, Kyrie. So as far as the funded debt to EBITDA and EBITDAR is concerned, that's more of a ratio on how leveraged you are, total debt compared to your annual cash flow, essentially. The debt service coverage, or you see fixed charge coverage ratios from time to time, those are a bigger comparison of current operations versus current obligations coming due. So obviously lenders are going to want to see that you've got the cash flow coming in to cover your current obligations as they're coming due. So that's why this covenant's usually included as well, with a combination of a funded debt covenant. But in this instance, again, your EBITDA number wouldn't change. But if your lease liabilities are added to those current obligations coming due, as far as debt, principal, lease obligations is concerned, that will drop I guess the ending result of the debt service coverage component. And in this instance, if a 1.1 was required, it would go from a pass to a fail again. And the next slide, Kyrie. If this was more of a lease adjusted calculation, similar to what we were showing previously with the funded debt to EBITDAR, if lease activity was already included in this debt service coverage calculation, you wouldn't see a change pre or post ASC-842, since the rent expense would not change with 100% operating lease portfolio, since it's still straight line. Next slide, Kyrie. So that was the quick exercise on debt covenant compliance, a high-level overview. I hope it was informative. Again, if you have any questions as you look at this further, may not be right now, but as you do more research yourself, there'll be some contact information come up here at the end for Kristen and myself. Would love to have further conversations with you to help answer those questions, facilitate the implementation. and to just assist and help you moving forward and continue to be that advisor. One last thing I wanted to talk about, as we've talked in multiple webinars before now, as well as this one, it's going to be a very significant undertaking, not only from a financial reporting side, but also from a time and effort side, as far as getting those numbers ready to be presented in your financial statements. And so there's going to be plenty of necessary updates in your internal control structure and process design, just to ensure you have the appropriate capture of any data. There's data integrity there. You have appropriate checks and balances in the process. If you're one of those entities like I was referring to, the Wendy's, Chipotle, the Big Lots, Bath and Body Works restaurant and retail industry, that this is going to be very significant. Obviously, you'll probably put a little bit further emphasis on this, but we'll have to have a process in place. And really, for anyone that has material lease activity, from the audit side, as we look at this year one, it's almost going to have to be a significant risk, and we're going to have to do a lot of additional analysis and work over it. So it's going to be an area you want to have appropriate controls in place to prevent any adjusting journal entries or things of that nature, but also any control deficiencies or even significant deficiencies, material weaknesses required to be communicated to those charged with governance of your entity. So I listed a few bullets here. Again, this is not an all-inclusive list, but these are a few of the common kind of process considerations and updates we've been seeing as it relates to ASC-842. It'll need to be tailored to your organization's complexity, your actual lease situation. And so this may not be verbatim what you're going to do. There may be additions, subtractions from this list. But first and foremost, there'll have to be updates to your financial reporting process, whether these are updates to a closed checklist each month, things you're analyzing, preventative controls as far as ensuring that you have a complete population of leases, reconciliation of some of those lease accounts, as Krista mentioned. You're probably going to want to set up a fixed rent, a variable rent, short-term rent accounts as separate disclosures required for all this in the footnotes. So that's the reason for setting up the separate accounts versus just lumping everything into one account. And so you'll want to have updates to the process to make sure you're capturing all that data. A control there could be related to use the third-party lease crunch or use the third-party lease query. And that's perfectly fine. I mean, they have an unqualified SOC 1 as far as their access controls and service organization controls are concerned. But then again, as the organization, you should also be doing some analysis of the data going in, the data coming out to make sure it's complete and accurate. You want to have additional management review controls, DTEC controls, as you might hear us refer to them as, over some of those reconciliations, some of the data pulls, the data entries, lease portfolios, things of that nature. As far as system user access rights are concerned, you may have appropriate IT general controls as far as your ERP system, consolidation software, any other reporting tools are concerned. But if you're utilizing a third party, the Lease Crunch, the Lease Query is another third-party software provider, you'll want to make sure that you're evaluating the access rights for that. Who has the access? What kind of access do they have? Are there periodic reviews of that access just to ensure the integrity of the data and also the logical access controls? And then last but not least, to the extent you have a lease negotiation team, other applicable operational personnel that are negotiating leases, negotiating renewals, have a little bit more insight and transparency to that than maybe general day-to-day accounting would. You should be having periodic collaboration with them to make sure you're made aware of any new leases, any changes to renewal terms or obligations of your existing portfolio, to the extent there are any embedded leases, which are just leases of an actual asset that you have usage to, maybe included within a service contract. Things that you should be having conversations about, periodically be made aware of, just as that could significantly impact your leasing calculations. Next slide, Kyria. And then the third and final CPE word is financial. The final word is financial.
And just to let everyone know, while we're submitting this code word, if you have any questions, please submit them through the questions box and we'd be happy to answer them here shortly. Thank you.
Thanks, Kyrie. Yeah, as she mentioned, if you do have any questions, please feel free. We got a few minutes left over here at the end. If not, that's perfectly fine. But we're always available via email, via phone for you to reach out. Kyrie, do you have another slide here at the end that has our contact info, or you can revert back to it? Those are our emails, our direct lines here at the office, and we're always willing to assist in those questions, to help with that implementation. We understand there's not a one-size-fits-all approach, and so the way we go about these webinars sometimes are a little bit more simplistic, a little more high level. Don't dig into the granular details there, but I know there's plenty of you out there today that have some of those maybe difficulties you're working through as you're starting to see what implementation is going to look like, and some of those challenges to address.
Yeah. Thanks, Tobin. There was actually one question that I was going to give a quick answer to. So the question came through, is this effective for intercompany leases where the landlord is a related party? So, you know, quick and long answer. So 842 does modify the treatment for related party leases. You know, the existing lease guidance, you know, 840 forced entities to look at some substance over form with leases. So 842 acknowledges that many related party transactions are not documented at arm's length, and that leases between related parties should be classified in accordance with the lease classification criteria. So if it's going to be eliminated, I think that you have some more, you know, if it's a consolidated financial statement, I think you have some more flexibility in separate financial statements. I think you should disclose it under the 840, but you should also follow the disclosure requirements for ASC-842, which is related party disclosures, which is just really the nature of the relationship and the description of the transactions. And then these disclosures would not apply that a transaction was at arm's length if it's not. So I think a little bit longer of an answer, but there will be some impact, but I think it does depend on your particular situation. I think that was the only question.
Yeah, I was just going to say we don't have any further questions, but again, like Tobin and Kristen mentioned, if you have any questions after you've reviewed everything, feel free to contact them. All their information is on this slide. Anything else, Tobin or Kristen?
Nope. Thanks for joining us.